Commodities like silver provide a way for investors to diversify their portfolio, and that's because they tend to have a low correlation with things like equity and bonds. But they do have a fundamental problem, which is knowing their fair price. So in this video, we'll look at the drivers of silver's price, but also a model which gives us at least a stab of knowing what silver is worth. Now, if you do want to keep abreast of markets and also macroeconomics, what better way could there be than to sign up for our free weekly market roundup? There'll be a link in the description below and above me. So now let's look at the price of silver in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Here's the price of gold in the top panel, silver in the middle panel, and platinum in the bottom panel. Now all three are classed as precious metals, and over time they generally track one another fairly closely. And you can see recently gold has had a great run, as has silver, whereas platinum has been left behind. If we look at the period since 2011 until August 2020, and we look at the risk-return plot with high risk on the right and low risk on the left, and low returns at the bottom and high returns at the top, platinum has actually had a negative return over that period, and to a lesser extent so has silver. And the reason for that is this very large spike in the price of silver around 2011. And gold also peaked around 2011. At the time, many people thought that money printing by the Fed was going to lead to runaway inflation in the US. However, that never materialized, and consequently the price of gold fell, as did the price of silver. But gold has managed to claw back a positive return since 2011. And if we look at the risk, you can see that silver is the most risky of the three precious metals, with a volatility that's just under 30%. Platinum's lower, and the volatility of gold over this period was about 16%. For comparison, I've also shown the life strategy funds here in the top left part of the graph, ranging from 100% equity in the top right to 80% bonds and 20% equity in the bottom left. And in fact, the return of all of these diversified funds was better than it was for any of the precious metals over this period. And the volatility of this globally diversified equity fund, which is Life Strategy 100, was lower than that of gold, and its return was considerably higher. Now, what really sets silver apart from gold are its many industrial uses. According to the US Geological Survey, the most common use for silver is in electronics, which is down to its very special physical properties. What it shares with gold is a popularity as part of jewelry, but also in its use as silverware. Coins and medals are also often made out of silver, but its use in photography has declined massively with the onset of digital photography. One of the chemical properties of silver is that its compounds can be very sensitive to light, and that's what initially led to its use in photography. But there's also a very large other category. The use of silver in electronics is now driven quite strongly by the increasing use of solar panels. Silver is also often used inside the turbines of windmills. Electrical components are often connected together with solder, and silver often makes up some of that solder. But silver also has medical properties because it can be used to kill bacteria. So it's often incorporated into things such as bandages. Because it's very difficult to wash off, silver compounds are sometimes used in elections to ensure that people don't vote twice. And the use of silver in mirrors dates back to the Roman period. So now let's look at the drivers of the price of silver. One thing that it has in common with gold is that silver doesn't generate an income. That means when interest rates are very high, risk-free assets such as US Treasuries would be much more attractive than a wasting asset such as silver or gold. And recently, as real interest rates have turned sharply negative, the price of silver has rallied very strongly. Like any commodity, it's also driven to some extent by the balance between demand and supply. And this graph, which is published by the Silver Institute, shows how demand has changed over time. You can see that photography, which is the dark red band, has now effectively become an insignificant driver of demand, whereas industrial uses, which are in light blue, are still very important, as is jewelry and of course investment. Now, because silver generally has more supply than demand, variations in demand can make a massive difference to the price of silver, and that also increases the volatility of the price of silver. In its latest forecast, the Silver Institute also expects that the biggest increase in long-term industrial demand for silver will come from battery-powered electric vehicles, but also hybrids. Now that's not because silver is used inside the battery itself, but because it's used in many of the electronic components which go inside an electric car. And the reason why silver is so sought after by the electronics industry is that it has a very low resistance to the flow of electricity. In fact, it's lower than any of these other metals. And that means that if you make electrodes out of silver, they make a very efficient and low resistance contact. The primary sources of silver come from South America, but also North America. Now, of course, recently with the lockdowns, productivity for silver mining has certainly fallen, and that drop in supply has been partially responsible for the increase in the price. But what's interesting is that silver is often a byproduct of other mines, such as lead and zinc mines, but also copper mines and gold mines, where it's mixed with the other metals and has to be purified. Precious metal investors often look at the ratio between the price of gold and the price of silver. So that's this light green line which you can see on this graph, which ranges from 1970 to 2020. And this is simply the number of ounces of silver that you can buy with a single ounce of gold. And because silver is always cheaper than gold, that's always more than one. So for example, in 1970, you could buy about 20 ounces of silver for every ounce of gold, whereas in 1990 it was much higher, which suggested that silver was much cheaper than gold at that time. If we zoom in on the period between 2003 and 2020, which is the graph on the right, you can see that the ratio has been gradually increasing as silver became relatively cheap compared to gold, until that peaked at an all-time record at the beginning of 2020. However, now that silver's rallied very strongly, much more quickly than gold in fact, the relative expensiveness of gold relative to silver has dropped very dramatically. And given that that's happened, the price of silver relative to gold now looks much more reasonable, and that could be a driver for future increases in the price of silver. If we look at flows into the biggest silver ETF, which is SLV issued by iShares, green here signifies an inflow into the fund. In other words, there are more buyers than sellers of the fund. Flows were fairly muted in 2018, but you can see in 2020 we've had a huge surge in interest in silver, as many people crowded into this silver trade. So it's useful to try and gauge what's the fair price of silver. Now you can't do this using a traditional model like a discounted cash flow model, and that's because silver generates no income. However, you can build a really simple regression model, which is a purely explanatory model, not a forecasting model, that looks at some of the drivers we've just seen. So remember, this is just a crude model, and you shouldn't believe in it too seriously, but it does give you a rough idea of what the fair price of silver should be. So the blue line here is the actual price of silver since 2003, and the red line is the value of the model. It's far from perfect, but it does roughly match what happens to the actual price of silver. And if we look at more recent changes in the price of silver since the beginning of 2020, you can see that the fair price of silver, according to the model, also increased sharply, largely because of the fall in real rates. If we fix the value of inflation and just vary the real interest rate here on the bottom axis between plus 2% and minus 2%, and we also vary the US trade-weighted dollar between 80 and 120, what you can see is that when the trade-weighted dollar is strong, the value of silver is low. And that's for a fairly obvious reason, which is that silver is priced in dollars. And a strong dollar means a weak silver price. And as we've already discussed, when interest rates are high, that also reduces the value of silver, because risk-free assets become much more attractive than wasting assets, like gold and silver. Currently, the 10-year real interest rate is below minus 1% in the middle of August in 2020. So that puts us in this column of the grid. And the value of the trade-weighted dollar is just under 110. So the fair value is around $22. If the dollar weakens, or if rates get even more negative, then that will drive the fair value of silver higher. If you want to reproduce this model, you can easily download these time series from the Fred database. So for example, you can get the 10-year real interest rate using this URL on Fred. And of course, if you're a Patreon supporter, we'll offer you a spreadsheet which can calculate this for you. So if you do want to get exposure to silver, you can do that via exchange-traded products. You don't have to buy physical bars of silver. In the US, these are the 6 largest exchange-traded products devoted to silver. Notice how the expense ratios tend to be very high. The cheapest one is the second on the list, the Aberdeen Standard Physical Silver Shares ETF. But the most popular certainly isn't the cheapest, and that's the iShares Silver Trust, which costs you 0.5% per year. But in terms of assets under management, it's by far the biggest. These two funds are leveraged and therefore fairly toxic because silver is already volatile and these will multiply up the volatility. But they do allow you to go short silver or long silver, but they come with extremely high expense ratios. These are the largest silver funds in the UK for UK investors, sorted by their expense ratio. Notice how they're all priced in US dollars, which means that as a UK investor, you'll also be taking the risk of sterling versus the US dollar. And the risk is, of course, that sterling strengthens versus the US dollar and reduces the price of silver in sterling. If sterling weakens, then that will increase the value of silver in British pounds. So at least some of that surge in the price of silver is fundamentally justified because of the very rapid drop in real interest rates. And while that remains the case, which it probably will for some time, given what's going on, then that's going to be a support for the price of silver. But of course, it's very volatile, and that's something you should bear in mind if you're going to incorporate it as part of your portfolio. If you enjoy our videos and you want to support us, then you can do that really easily by going to Patreon. There's a link above me on this page. And if you do that, you get access to lots of great stuff. You can ask questions of me and other members of the community via this application for chatting to each other called Slack. We also have a very friendly, regular call on a Sunday evening where you can ask any question you like and I answer them live. There's also a video replay which is available afterwards. And we have a growing library of explainers which are exclusively for our members. And you can see 2 of the latest examples of that here beside me. And alongside the video, you also get access to the notes so that you can research each topic in more detail yourself. So if you do want to join us or just support us, then click on that Patreon symbol on the far side of the page. It would be wonderful to see you as part of the community. And as always, thank you for listening.